What is up, everyone, and welcome back to the channel. If you've been looking at your portfolio lately and feeling like you're on the world's most unpredictable roller coaster, trust me, you are not alone. It feels like every single week we're hit with a tidal wave of news that sends the market flying up or crashing down. That's exactly why we do these Saturday news roundups, to cut through the noise, give you the real story, and make you a smarter, more confident investor. And today's video is a big one. I'm going to do three things for you. First, I'm going to pull out my crystal ball and tell you exactly what I see happening in the stock market over the next 4 to 8 weeks. Second, we're going to break down the huge news from this past week, from the Middle East to Washington, D.C. That's been shaking everything up. And third, and most importantly, I'm going to share my personal game plan for how to invest through this chaos and set yourself up for what I believe could be a massive bull market. You're going to want to stick around for that. Ready? Let's get into it. Critical dates. All right, first things first. Whip out your phone, open your calendar app, because you are not going to want to miss these dates. These are the days over the next month that could seriously move the market. June 18th, the FOMC decision. Think of this as the Federal Reserve's big meeting. We don't expect them to change interest rates, but we're going to be hanging on every single word Jerome Powell says. His tone is what matters. Is he worried? Confident? That will tell us everything. June 27th, final Q1 GDP. This is the official health check of the U.S. economy. It confirms how fast we were growing in the first quarter. A strong number is good, a weak number, not so much. July 3rd, the June jobs report. This one is huge. Are people getting hired? Are wages going up? The Fed watches this report like a hawk to decide what to do with interest rates. July 10th, CPI inflation report. This is the big one. The report card on inflation. This is probably the single most watched number by Wall Street right now. And finally, July 15th, Q2 earnings season kicks off. This is when all the big companies, starting with the giant banks like J.P. Morgan and Bank of America, open up their books and tell us how much money they made. Their results set the tone for the entire market. So with all those catalysts, the next 4 to 8 weeks could go one of three ways. Think of it like a choose-your-own-adventure for your portfolio. The three diverging paths. Path number 1, the base case, modest gains. Let's call this the Goldilocks scenario. The trade talks with China go okay, the Fed doesn't do anything crazy, and earnings are fine. In this world, we probably see the market slowly grind up, maybe 2 to 5%. Nice and steady. Path number 2, the volatility shock, a pullback. This is the uh-oh scenario. Trump slaps on some unexpected tariffs, the Fed says something that spooks everyone, or a few big companies miss their earnings. If this happens, we could easily see a 3 to 7% pull back. It would be scary, but not a full-blown crash. Path number 3, the bullish surprise, a rocket ship. This is the one we all dream about. Some mind-blowing AI news drops, or the Fed suddenly signals they're going to cut rates sooner than expected. That could pour gasoline on the fire and send the market jumping 5 to 8% in a flash. The biggest risks to watch out for? Stocks are expensive right now, politicians can be unpredictable, and trade wars are always a threat. But the positives? Corporate earnings could still be strong, and a Fed pause is a powerful tailwind for stocks. But underneath all of this is the real drama, the stuff happening behind the scenes in Washington that could set the stage for the next 5 years. Let's talk about the Fed chair. The current chair, Jerome Powell, has been keeping interest rates high to fight inflation. It's like giving the economy some tough medicine. It doesn't feel good, but it's meant to stop a bigger problem down the road. Well, former President Trump wants him to slash those rates, and he's been very public about it. The Fed chair's term is up mid-year next year. Now, why does he want low rates so badly? 3 simple reasons. 1. It makes borrowing cheap for big businesses. If you're Apple and want to build a new billion-dollar factory, A lower interest rate saves you a fortune. It encourages companies to spend and hire. 2. It helps with our national debt. The U.S. has a giant credit card bill. Just like you'd rather pay 3% interest on your credit card than 5%, the government wants to pay less interest on its debt. Lower rates help a ton. 3. It makes the economy feel amazing. This is the big one. When the Fed cuts rates, the stock market usually shoots up. Home prices eventually follow because mortgages get cheaper. It basically turns on the economic engine. And when things feel good, that looks great for the president, especially with the 2026 midterm elections on the horizon. But here's the catch, and this is so important. Cutting rates too low too fast is like chugging 5 energy drinks. You'll feel incredible for a few hours, but the crash is inevitable, and it's going to be brutal. It could cause inflation to come roaring back. Asset prices, stocks, real estate, everything could get pumped up into a massive artificial bubble. And that leads me to my big prediction. I want you to prepare for a scenario where, starting around mid-2026, after a new Fed chair is in place, we see a massive 2 to 3 year bull market. It might be artificially propped up, but it will feel like the good times are back. But I don't want you to get lost in the hype, because I believe this could be setting us up for a perfect storm around 2030, a huge crash across all markets. So what's the play? Let your assets grow during those good years, but be ready. Be prepared. Don't get caught by surprise. We'll talk more about the exact strategy at the end of the video. All right, let's pivot to the other major event that rocked the markets this week. The escalating tension in the Middle East. Overnight Thursday, Israel launched strikes on Iran. This immediately ignited fears of a much wider conflict, and the market hates uncertainty. When investors get scared, they do one thing. They run for safety. We saw a classic risk-off day. The Dow, the S&P 500, the Nasdaq, all down. Meanwhile, oil prices surged almost 8% at one point. Why does that matter to you? Higher oil means higher gas prices and higher shipping costs for everything you buy, which fuels inflation. And those safe haven assets? Gold shot up over 1%. The U.S. dollar got stronger. Investors were basically hiding their money under the mattress, financially speaking. What we need to watch now is Iran's response. Any retaliation could keep this volatility going for a while. So with all this happening, what are the big Wall Street brains saying? Jeffrey Gundlach, the bond king, is waving a caution flag. He says U.S. stocks look overvalued, similar to the vibe right before the 2008 crash. He's bearish on long-term government bonds, but bullish on gold. He sees a major buying opportunity coming, but only after a pullback. Morgan Stanley agrees. They're saying that with AI and tech stocks priced for absolute perfection, there is zero room for error. Any tiny negative surprise could spark a sell-off. But here's the most important one for us long-term investors, and it comes from BlackRock. They highlight that while the mega-cap tech stocks are leading the charge, a broader rally among value stocks and cyclicals is expected. This is why I have been pounding the table on funds like SCHD. I know you're feeling the pain. I am too. I am heavily invested in SCHD, and it has been in a slump. But I promise you, this is how market cycles work. Tech has its day in the sun, and then the money rotates. Value investing, buying solid, profitable companies that pay dividends, is going to make a comeback. When the Fed eventually does cut rates, those high-yield savings accounts paying 5% won't look so hot anymore. All that cash sitting on the sidelines is going to come flooding back into the market, looking for a home in high-quality, value-oriented companies. The exact kind of companies inside SCHD, patience will be rewarded. Okay, quick highlights from the rest of the week. U.S.-China trade talks in London had some renewed optimism, which gave the market a nice boost early in the week. But at the same time, tariff jitters came back as Trump threatened more tariffs, causing some intraday swings. Inflation data was good. It showed prices are cooling, which takes pressure off the Fed to stay aggressive. And finally, the U.S. dollar has weakened, which is like putting U.S. assets on sale for the rest of the world. This created a rare trifecta where stocks, gold, and Bitcoin all rallied at the same time. Okay, so we've covered the Fed drama, global tensions, expert opinions, and a crazy week of news. The big question is, what do you do with your money right now? We're all feeling like we're skating on thin ice. So let me be crystal clear. This is not the time to take your life savings and YOLO it into the stock market. But if you're already invested in good, broad ETFs like the S&P 500, this is also not the time to panic and pull your money out. Stay the course. The smartest strategy in this environment is dollar cost averaging. If you have cash on the sidelines and you already have your 6 to 12-month emergency fund squared away, your job for the rest of 2024 and 2025 is to systematically invest. Pick a day every week or every month and buy. On red days when the market is down 2 or 3%, maybe you buy a little extra. You're getting a discount. On green days, you still buy because you're building your position for the long term. Unless we see some insane 20% one-day crash, which I do not expect, lump sum investing is too risky right now. Slow and steady wins this race. My personal plan is to dollar cost average through all the peaks and valleys of 2025, with the goal of being fully invested by mid-2026. I want all my capital in the game before that new Fed chair potentially gets in and hits the accelerator on the economy. I want to be on the train before it leaves the station. Woo, that was a lot, but I hope it gave you a clear roadmap. I'll be right back here next Saturday for the next news roundup to keep you ahead of the curve. Thank you so much for watching. Stay smart, stay patient, and I'll see you in the next one.